Hello guys. First I will introduce myself, then will discuss about the solvency ratio. I am Dr. Ambuli, working as Associate Professor in SRM Institute of Science and Technology, Ramapuram. I am going to discuss about the topic solvency ratio. So first we'll see what is the term ratio. Ratio refers to one number we are going to find a relationship with another number, or we can say ratio refers to relationship between two numerical values that we can call as ratio. Ratio can be expressed in proportion, times, percentage, fraction, days or month or weeks. Next we are going to discuss about what is the term accounting ratio. If you are computing the ratio on the basis of accounting information, then we can call this accounting ratio, or we can say that using the accounting data or using the information from accounting record, and we are computing the relation between two numerical value which is presented in accounting record, that we can call this accounting ratio. For example, we'll record all expenses, incomes, assets and liability which are in financial nature will maintain the book of accounts. Those information we are analyzing a tool, that is ratio, and finding relationship between those two accounting variable, those two financial variable, that we can call as accounting ratio. So either between incomes or incomes and expenditure, or between expenditure or between assets, or between liability, or one from income, another from asset. So any combination we are finding relationship and we are computing a ratio, such ratio only we can call as accounting ratio. Next we are going to discuss about what is the term ratio analysis. Ratio analysis refers to a technique or tool analyzing the financial statement by using a tool that is nothing but ratio. We have various tools to analyze our financial statement. One of the tool only is ratio analysis. So the financial statement we are analyzed by using a ratio tool that we can call as ratio analysis. This ratio analysis implies, or the steps we are going to follow is nothing but comparing, that is between two financial variables, and determining and presenting the relationship of items or group of items which is available or which are presented in financial statement. Now we are going to discuss the topic, the classification of accounting ratios. So here we have two types of ratios. One is traditional ratio, another one is functional ratio. Traditional ratios refers to the ratio which are computed based on the origin in the financial statement. Because when you say it's a financial statement, we have three-tier structure. One is trading account, another one is profit loss account, or another one will be balance sheet. Or the financial statement we can call as income and expenditure account and balance sheet. Okay, so from where we are using the data for computing a ratio, that only we can call as traditional ratio. Suppose we are taking a data only from balance sheet, or we are taking data only from income and expenditure account, and based on that the name has been given in the case of traditional ratios. On the basis, there are three types of ratios. One is balance sheet ratio, number 2 profitability ratio, and number 3 composite ratio. The next one will be a functional ratios. That is, this ratio we are computed based on the function or the operation or the activity which are carried out in our business. So based on how we are carried out the business, so we are using the financial variable from the financial statement. On the basis we are computing a ratio, such ratio only we can call as functional ratio. So we want to identify, based on the financial statement, we want to identify what is the profit of the business, how the business is operating, whether efficiently operated or not, and what is the financial position or soundness of the business. So all these we are identified only from the financial statement or the financial variable which is given in your financial statement. So on the basis we are calculating ratio, those ratio only we can call as functional ratios. Under functional ratios we have classification. Number 1 will be financial ratio, number 2 profitability ratio, and number 3 turnover ratio. So today we are going to discuss about the concept is nothing but the financial or solvency ratio. So here in this case the previously what we have discussed is nothing but the basic information which we want to aware about this ratio analysis. That's why just I simply explained about those concepts. Now we are going to detailedly explain. I'm going to explain about the financial ratio or the solvency ratio. The financial ratio or solvency ratio, it is otherwise called as balance sheet ratio. Okay. So here in the financial ratio we are going to compute only the information which is available in the balance sheet. So what is the term balance sheet? Balance sheet is nothing but a statement which consists of assets and liabilities. Okay, so here the main purpose of preparing the balance sheet in order to know the financial soundness of the business. That's why it is called a solvency ratio or balance sheet ratio or a financial ratio. Under financial ratio, it has two classification. Number 1 will be the short-term solvency ratio and number 2 will be long-term solvency ratio. First, we'll see what is the term short-term solvency ratio. So the short-term solvency ratio, it refers to, we are going to compute the ratio only in order to determine the short-term asset and short-term liability. We are going to consider only the current asset and current liability from the balance sheet. Okay, the main purpose of preparing or computing the short-term solvency ratio is nothing but to identify the ability of the business to repay the current liability from the revenue or the source which are generated from the current asset. This ratio is used to assess the short-term solvency of the business. So that means whether the business can continue without stoppage in the production or the process. So in order to identify that, we are going to compute the short-term solvency ratio. Under short-term solvency ratio, we have three ratios. Number 1 current ratio, number 2 quick ratio, and number 3 cash position ratio. The next one will be the long-term solvency ratio. So the main purpose of computing a long-term solvency ratio in order to identify the particular business which are able to meet out the long-term liability, or in order to assess the long-term solvency position of the business. That is, the business has continued forever, the business can survive forever. In order to identify that, we are computing the long-term solvency ratio. Under long-term solvency ratio, we have three ratios. Number 1 fixed asset ratio, number 2 property ratio, and number 3 debt equity ratio. So in order to solve the ratio, just I prepared a balance sheet format. So based on this format only, we are going to compute this ratio, and we are going to substitute the value in the formula and find out the ratio. Just I prepare this balance sheet. So here when you say as a balance sheet, is a statement which consists of liability and asset. Based on that, I've just prepared this. See the liability side. The liability are classified into two categories. One is internal liability, another one is external liability. Under internal liability, I mentioned only the 4 important items. Number 1 will be share capital, number 2 reserves, and number 3 profit and loss, and number 4 is share premium. So first we'll see what is the term internal liability. So the business liable to pay or committed to pay to the owner of the business, such liability only we can call as internal liability. The next one will be external liability, that is nothing but the business liable to pay to outsider of the business. Such liability only we can call as external liability or outsider liability. Here under external liability we have two types. One is long-term liability, another one is short-term liability. So what is the term long-term liability? So when a business repay the amount after 5 years, such liability only we can call as long-term liability. Short-term liability or current liability, it refers to when a business repay the liability within a year, within 12-month period. Such liability we can call as current liability. So under long-term liability we have 3 liability. Number 1 debenture, number 2 public debt, and number 3 long-term loan. Under current liability we have the following liabilities: sundry creditors, bills payable, bank overdraft, outstanding expenses, prepaid income, provision for tax, and proposed dividend. Then next we'll see on the other side of the balance sheet is nothing but asset. Here for ratio purpose I classify the asset into 3 categories. Number 1 tangible asset, number 2 intangible asset, and number 3 fictitious asset. First we'll see what is the term tangible asset. The assets which can be seen, touch and feel, those assets we can call as tangible asset. Under tangible asset again I have classified into 2 categories. One is fixed asset and number 2 current asset. Under fixed asset I mentioned land and building, plant and machinery, furniture and fixture, etc. So what is the term fixed asset? Fixed asset we can call as permanent asset. Those assets which cannot be easily converted to cash. So these assets will not yield a profit immediately once you have invested money. It takes some time, but it gives a return, it yields a return until the business will survive. Such asset only we can call as fixed asset or permanent asset. The next one will be a current asset. So these assets are the asset which are easily converted to be cash. Once you have started invested, from that you can generate a revenue from this asset. The following are the current asset: cash in hand, cash at bank, bank balance, marketable securities, short-term investment, temporary investment, bills receivable, sundry creditors, closing stock, prepaid expenses, and outstanding income. Okay, so these are the various assets in the case of current asset. Then the next classification, second classification asset is nothing but intangible asset. So those assets which cannot be seen, touch, but it has some value of money. Those assets only we can call as intangible asset. Under that we have 4 classification: goodwill, patent, copyright, and trademark. Then third one will be the classification we can call as fictitious asset. Actually it is not an asset. So at the time of establishing a business, we have incurred some expenditure in order to make the business to be a prominent to others. So those expenditure we are considered as asset for the business, because for the survival of the business. So in such a category, we have preliminary expenses, any loss incurred during the business, and at the time of issuing any security, we are issued at discount. All this we can call as a fictitious asset. So based on the balance sheet format, we are going to compute the short-term solvency and long-term solvency ratio. The first one, we are going to see about the short-term solvency ratio. Under that, first we are going to discuss about the current ratio. So current ratio is nothing but the ratio which are going to find out the relation between the current asset and the current liability. The main purpose of computing this ratio in order to find out or in order to identify whether the particular business is able to meet that short-term liability or current liability from the revenue they are generated from the current asset. So for that purpose only we are computing the current ratio. The current ratio is nothing but current asset divided by current liability. So already in the format I gave what is the current asset and what is current liability and what are the list of current asset and current liability. The next one is liquid ratio. So this ratio is otherwise called as acid test ratio, or we can call as a quick ratio. Okay, so this ratio we are going to compute, that is what is the ability of the firm to pay off the current liability with the help of the quick asset or the liquid asset. So when you say as a liquid asset, it refers to from the current asset, if you are subtracting the stock and prepaid expenses, what is the leftover? The asset which is the value of asset which is available in the business, that we can call as liquid asset. So this asset can be converted into cash immediately compared to your current asset. That's why it is called as liquid asset or quick asset. The formula of computing the liquid ratio is nothing but that is liquid asset divided by current liability. Liquid asset refers to from the current asset, if you have subtracted two important current assets, that is nothing but stock and prepaid expenses. If you subtract these two, what is left over only we can call as liquid asset. So already we have discussed that is current liability as well as liquid asset. The next short-term solvency ratio is nothing but cash position ratio. This ratio is also called as near cash ratio and cash ratio. That is, this ratio we are going to compute to find out the relation between the cash in hand, cash at bank and marketable securities, along with that the current liability. That is, the main purpose of computing this ratio is nothing but so how this immediate cash, that is what is raw cash in a business, how this raw cash we are going to meet out our current liability. That for that purpose only we are going to calculate the cash position ratio. This ratio we are going to compute by using this formula: cash in hand, cash at bank plus marketable securities and divided by current liability. The next we are going to discuss about the long-term solvency ratio. So under long-term solvency ratio we have three ratios, the main three ratios. One is proprietary ratio, number 2 fixed asset ratio, and number 3 debt equity ratio. The first we'll see what is proprietary ratio. So proprietary ratio is actually related to the proprietor of the business, that is related to the investor of the business. So here we are going to find a relationship between the shareholder fund with the total tangible assets. Okay, so this ratio is also otherwise called as capital ratio or net worth ratio or total asset ratio. Okay, so here, so how the total asset we have related with the internal liability of the business. So for that purpose only we are computing this proprietary ratio. The next one, we are going to compute the debt equity ratio. So this ratio, we are going to find a relationship between the external liability with the internal liability. That is, what is the relation between the external liability and internal liability, or long-term debt with the internal liability. So in such a way, we are going to compute this debt equity ratio. So what is the debt we have, and what is the internal liability we have, how the business is going to pay off these two liability. So for that, we are going to find out the relationship that is called as debt equity ratio. Then the last ratio under the solvency ratio is nothing but fixed asset ratio. This ratio find out the relationship between the net fixed asset and the long-term fund. So you already know about what is the term fixed asset. So here net fixed asset refers to, from the fixed asset, if you are subtracted the depreciation, then what is the balance value you have of the particular asset in the business, that only we can call this net fixed asset. Then what is the term long-term fund? Long-term fund is nothing but, so internal liability of the business, along with that any long-term liability of the business added together, that we can call as long-term fund. So these are the various ratios we are going to compute by using this problem. See here, this is the balance sheet of a company, X company, of 31st March 2021. We have liabilities and assets, they are given. So by using this data, we are going to calculate the financial ratio or balance sheet ratio or solvency ratio. That means, so we are going to take only the information which is given in balance sheet and we are going to compute the ratio. Okay. The first ratio, we are going to calculate current ratio. So already we have discussed about the formula. Now we are going to calculate your current ratio equal to current asset divided by current liability. So here from the balance sheet we want to pick out the current asset and current liabilities. So first we will pick out the value which is the information which is given in the asset side of your balance, because current asset belongs on the asset side. So I am going to take the data, derive the data from the asset side of the balance sheet. So in the asset side of this company, they are given fixed asset, current asset and intangible asset, they are given as per the format which I discussed now. So here under the current asset, just you can see stock, sundry debtors, advances, bank balance and cash in hand. So these value only I am going to take it as a total of current asset. See here already I computed. So you see the working note under the current asset, just adding all this value, I am getting 1,35,000. I am substituting here. Then similarly, the formula we require current liability. The current liability we want to take it from the liability side of the balance sheet. So in the liability side of the balance sheet, they are given internal liability, equity share capital, reserves, profit and loss, and non-current liability, that is nothing but external liability or long-term liability they are given, and we have current liability they are given as a list. Okay, so under current liability they are given three values: 50,000, 30,000, that is sundry debtor of 50,000, bank order of 30,000 and provision for tax 20,000. So totally we have 1 lakh rupees. This 1 lakh rupees I am substituting here, and 1,35,000 divided by 1 lakh, I am getting 1.35 times. So always guys, in the case of solvency ratio or financial ratio or balance sheet ratio, you want to represent the answer in times. The next one we'll see the liquid ratio. So the formula for computing a liquid ratio is nothing but liquid asset divided by liquid liability, that is a current liability. So how to calculate the liquid asset? So current asset minus stock plus prepaid expenses divided by current liability. So in this problem, they are given the current asset. Already we have computed 1,35,000 as a current asset. So from that, we want to subtract the value of stock is given in your balance sheet 40,000. Prepaid expense not given in a question. That's why I am substituting 0 here. So from 1,35,000, if you have subtracted 40,000, I am getting 90,000. Then the current liability is 1 lakh rupees, that I am dividing by 1 lakh, I am getting 0.95 times. The next solvency ratio I am going to compute is nothing but cash position ratio. That is cash plus cash in hand plus cash at bank plus marketable security divided by current liability. So in this problem they are given cash in hand and cash at bank they are given, and marketable security is not given in the question. See the balance sheet, I show the balance sheet. So here we have bank balance, cash in hand only is given. That's two data only I am substituting here. There is no marketable securities. That's why just the two value I am just substituting here. The marketable security is not the 0 divided by current liability. Already I computed 1 lakh rupees. So 36,000 divided by 1 lakh, I am getting 0.36 times. The next I am going to compute the debt equity ratio. That is, debt equity ratio is nothing but long term debt divided by shareholder fund. So just I am going to find out the data from the balance sheet on the liability side. So in the liability side they are given the non-current liability, that is long-term liability they are given. Under long-term liability they are given only the secured loan. So secured loan is nothing but long-term liability 70,000, that I am substituting there. See here, just I am substituting in the denominator 70,000 divided by shareholder fund. Shareholder fund is nothing but the total internal liability. So see the balance sheet liability side, the internal liability they are given equity share capital 1 lakh, reserves 25,000 and profit and loss account 40,000. Added these three data, I am getting 1,65,000. That only I am substituting in the formula. See here 1,65,000. So from 70,000 divided by 1,65,000, I am getting 0.42 times. So the debt equity ratio is nothing but 0.42 times as per the X company limited. The next one I am going to compute fixed asset ratio. The fixed asset ratio we are going to compute by using the formula net fixed asset divided by long term fund. So here we want to consider the net fixed asset from the asset side of balance sheet. See the balance sheet asset side. So they are given directly a fixed asset 1,50,000. There is no depreciation is given. So whatever the value of fixed asset is given here, that itself I am assuming as a net fixed asset. So net fixed asset 1,50,000. I am substituting long term fund. So I want to compute long term fund. Long term fund is nothing but internal liability plus long term loan. So here see the balance sheet liability side, internal liability 1 lakh plus 25,000 plus 40,000, these three only we can call as internal liability. So 1,65,000. Along with that we have a long term liability, that is 70,000. 1,65,000 plus 70,000 added together, what is the value you are getting? That only I have substituted here. So you see here 2,35,000. 1,65,000 plus 70,000, I am getting 2,35,000. So by using that I am computing the 0.64 times. So these are the various ratios we have calculated and we have computed and we have discussed in the financial ratio. So thank you guys. We'll see the next ratio, profit ratio in the next video. Thank you.